All right. Now, we know from the 82 experience that we jumped from that level and the bull market ensued. So are you saying in 2022, we fall down how much? And then is that the turnaround year?
If I were to look for a turnaround year with some confidence, I would say 2022 could be it, simply because of this 20-year cycle.
So what happens in the meantime
consistent.
then, Peter? I'm sorry. What happens in the meantime ahead of that?
In the meantime, we see one hell of a bear market. Now, as I said, we've had favorable seasonality working for us into June of next year. Can we hold up through June of next year? My best guess is that we cannot, but there's that possibility. The market does hold up into June of next year because of the seasonality factors within the presidential cycle. But from that point on, I think the market would be in a lot of trouble. And as I told you before, Neil, I'm looking for at least as bad a decline as we saw from 2007 to 2009, which was in the minus 55% category. So I think we're facing that realistically, and perhaps even worse than that. We haven't seen
that would be on
an
let's
undervalued
say
market.
If this applied to all the major averages, using the Dow as a good one for the time being, at around 25,000, that would bring it down to 12.5, 13,000.
Right around there, yeah.
Now that's pretty steep.
It's a big decline. We have not seen an undervalued market.
So what do you do? What do you tell your customers and your clients? What do you tell them to do?
Well, we actually play the market to the downside, and in fact, today we are dual leverage short, so we're taking advantage of this market decline. That's hard to do.
In other words, betting on stocks continue to go down.
That's correct, at least for the short term here. We look at that every single day, but right now we're looking for stocks to go down. And I would my best guess that we're at least going to break the recent low. At that recent low, Neil, one of my favorite technical indicators is the trading index ARMS index, which simply looks at up and down stocks versus up and down volume. Are the up stocks getting their share of volume? If they're getting more than their share of volume, that indicates that the investors are bullish because most of their money is going into the up stocks. If the down stocks are getting more than their fair share in terms of a ratio of money, that means that people are beginning to get fearful. At this most recent bottom that we saw, there was virtually no fear at all. That 10-day moving average of the TRIN ARMS index, trading index, was around 1.15. A good market bottom shows that at 1.30 or higher. So
we should just
I know
explain
that's technical.
It's a contrarian indicator. If people are not that worried, that can be a worry, right?
Absolutely, yeah. What you need to see to get a good bottom in the market, as you know, Neil, is real fear. And there's been no fear at all in the last couple of months. That decline in October was looked upon as just another quick down move, and let's jump in and buy stocks now.
Peter, there are just as good number of bulls who come on and say, with the sell-off of late, and we are at much more affordable levels. This is not a rich market. You say it is.
Oh, very much so. Very much so. If people are looking and saying, see, a lot of people just look at PE ratios, Neil, and that's one of the poorest ways of evaluating stocks is price to earnings ratios. Right. Because you get estimates that are usually way off. In fact, what a lot of people like to do, what the bulls like to do, is bring out earnings estimates for the next year. And they say, well, based on earnings estimates for the next year, the PE ratios are really low. You show me how many times those earnings estimates for the next year are correct. They're hardly ever correct. So the people that want to be bullish take advantage of that and say, oh, no, we're not overvalued at all. In fact, on a forwards earnings estimate, we have a PE ratio of 10 or 12, very much undervalued. It's the argument they like to make, and it's a fallacious argument, Neil.
Peter, I think what makes you also very scary is that incredible voice of yours. If you had a high-pitched voice, I think most people wouldn't pay attention. But I think they pay attention all the more. It's very good seeing you, my friend. I hope you have a great Thanksgiving.
Always good to talk to you, Neil. You too, with your family.
All right, Peter Eliades, you can agree or disagree, but he is an institution and saw many, many trends in this market over the decades that bear repeating here. Remember, we don't book bulls without bears. We don't book Republicans without Democrats. That is the essence of fair and balance when it comes to you and your money.